Okay, today we're interviewing Mark Casey from CFN Services. Good day, Mark.
Good day, thanks. Great to be here.
Mark, tell us a little bit about your company and what you do.
CFN Services is a global provider of trading infrastructure around the world, across North and South America, Europe, and Asia. And we simply simplify trading infrastructure for buy-side, sell-side, and service provider firms, making it easier to deploy infrastructure across data centers around the world. And as we know, liquidity is moving into data centers. Today we connect about 70 data centers around the world, and we're expanding that to over 400 over the next couple of years, so that it makes it very easy for firms to extend their trading infrastructure where it needs to be, simply, cost-effectively.
Okay, and tell us some of the main data centers you're in and the kind of latency that exists between them.
Well, we focus on major liquidity across equities, futures, options, derivatives, and foreign exchange. And so we're in the major equities exchanges around the world, certainly London Stock Exchange, New York Stock Exchange, NASDAQ, the Chicago Mercantile Exchange. And so that extends really globally, as well as many of the alternative exchanges. And so the key data centers in the New York markets, in the London markets, in the Frankfurt markets, we're here at TradeTech announcing the expansion of our core platform, the Alpha platform, beyond London and Frankfurt to more markets, going deeper into the European trading infrastructure.
Okay, and give us some examples, some of the latencies between the major venues that you can provide. I know it's a common question.
Well, I think our platform is built to deliver the lowest latency. The legacy of our client set is high-frequency trading, and those clients that are out looking for very low-risk arbitrage and running very low-risk arbitrage strategies. So between any two given venues, we enable the best latencies. Between New York and London, for example, we're in the sub 65 millisecond, sub 64 millisecond range. Between New York and Chicago, we're in the sub 15 millisecond range. Specifically today, the best latency between Chicago and New York is 14.6 milliseconds. That's where we are. We'll see improvements on that over the next couple of weeks to 14.3 and then ultimately 14.1. And so those are the kinds of evergreen latency improvements that you see on our trading platform. And it's designed with that evergreen component in mind, so that you're not constantly having to have a team of IT professionals out there looking for the next best latency, if latency is important, and recognizing that latency is not important for all of trading. It's important for very specific segments of trading. Performance is important across all of trading, and so our platform delivers performance and cost effectiveness for the right trading application for the right type of trading firm.
And tell me, you deliver more than just low latency services. You've got a platform. You have cloud computing. Tell us about your complete offering.
Sure. Well, it certainly starts with the global wide area network connectivity that connects the data centers that house the liquidity, and from there we build up into the trading stack. And so we have a market data delivery platform that rides on that core infrastructure, and then from there we start to build trading applications on top of that. And we don't actually create the trading applications. We're trading application agnostic. What we enable is off-the-shelf trading applications from firms like those that are here at TradeTech, whether that's a ticker plant vendor or an OMS EMS vendor. Whether it actually doesn't matter whether it's front, middle, or back office applications, you can house all of those in the optimal environment. You certainly want your front office applications, if you're performance sensitive, to be proximity hosted. If you're a little bit less performance sensitive, you might centrally proximity host. In other words, you might deploy a single node in London to trade the European equities markets. You might deploy a single node in New York to trade the New York equities markets. And so we continue to build on top of that platform. We're here also at TradeTech announcing the deployment of our Alpha platform on demand, which is really the first public cloud for global financial services, and that further simplifies the ability to deliver performance in a front and back office environment.
Mark, what would you say about TradeTech 2012, and on a broader level, how the European data network market compares with the U.S. Market, without pulling any punches, and then on a broader level, the global market?
Sure. Well, so TradeTech 2012 has been great for us. This is really our big launch event. We've been in the European markets for several years now, but we're expanding that presence. We, as a North American firm, have built our business around some of the most sophisticated high-frequency traders in the North American markets, but the European firms, some European proprietary trading firms in particular, don't have as much visibility to us. And so the TradeTech's been a great venue for us to come in and get some more recognition, get some exposure for who we are and what we're doing. Relative to the levels of infrastructure, I mean, I think the North American markets and the European markets are very similar in makeup. I think there's a little bit more fragmentation of liquidity across the U.S. markets, particularly in the New York market, where we're dealing with a dozen and a half data centers housing liquidity in various forms. Certainly we have probably close to a dozen here in London, but beyond that the numbers start to drop off precipitously. You go to Toronto and we're talking about 4 data centers. You go to Frankfurt and we're talking about a couple of data centers, and we go to Madrid and we're talking about 1 or 2 data centers. And so the level of infrastructure complexity, as you expand the number of markets you're trading, grows exponentially. And again, that's part of what we're here to solve, and that's why this is a great venue for us to sort of get our name out there and tell folks how we can help solve those business challenges cost effectively and simply.
Okay, and give us some examples of typical cost deployment and type of customer, and if you can, some typical customers.
Sure. Well, there's a very, very broad range in terms of type of customer and associated cost. The core of our Alpha platform was built around custom market data delivery networks for the most sophisticated high-frequency traders, those that are seeking very low to no risk arbitrage strategies, and they live in a world of absolute speed. Those are also very, very expensive networks. They're custom infrastructures designed specifically to support the needs of a proprietary trading firm. As electronic trading grows, we see broader and broader sets of companies coming into the market. And so we can go to the other end of the spectrum, where our Alpha Platform on Demand as a public cloud service, we're essentially building very cost-effective entry points for maybe 2 traders who are leaving a larger firm to start their own shop. And they can trade in a very high-performance environment at a fraction of the cost using shared infrastructure, shared trading components, shared trading applications, in some cases open source applications that they can customize themselves. And so we look at the high-end infrastructure, which can be in the millions of dollars a year, to low-end infrastructure, which can be a couple $1,000s a month, or $10,000 or $15,000 a year. So very wide range. The performance range is reasonably broad, but within a spectrum, it's all high performance, and I think that's the key: is how do you deliver high performance cost effectively? At the high end, it does take a lot of money. At the low end, it doesn't take nearly as much money. People can get a lot more performance for their buck than they might otherwise recognize.
Okay, and let's talk about the emerging markets outside Europe and North America. I know a lot of people write them off, but obviously they're increasingly important. You have Johannesburg, Brazil, obviously Tokyo is an advanced market, the Far East, Australia, where people are not very well, it takes a long time to hop. So tell us about those things.
Well, I think the emerging markets represent huge opportunities. Certainly the high-frequency trading firms are leading the way into those markets because there are large untapped markets. As markets in North America and Europe become more competitive from a high-frequency trading perspective, the high-frequency trading firms are looking for these emerging markets where they can go and find new opportunities with less competition. I think Brazil is a significant example of that kind of an opportunity. We see a sort of a massive move to Sao Paulo. We see the Asian markets. I mean, if there's a buzzword for 2012, it's the Asian markets. And certainly, as you said, Tokyo is fairly well developed. They launched the Arrowhead matching engine, 2 years ago now. But the other markets are really just getting there. And so Singapore, Sydney, Hong Kong, all represent opportunities. And even markets beyond that, where you're still only doing maybe some domestic trading. Markets like Seoul and Shanghai are also all markets where we're seeing growing interest from our clients and a growing list of prospects as well.
And would you call the growth exponential across the different markets still? I mean, what's the rate of growth in these different markets?
Yeah, I don't know if it's technically exponential, but it's certainly steep linear. The growth is very rapid. Again, you've got some markets that are maturing and seeing maybe a flattening of that growth curve a little bit, but these new emerging markets are really still picking up speed as people get familiar with them, understand the opportunities, and in some cases, as those markets, while we have increasing regulation in, particularly U.S. and European markets, in Asian markets, we potentially are looking forward to less regulation, right? The opening up of domestic trading markets, and more and newer and better electronic technologies and matching engines. Okay,
and how do you see the split across asset classes? Forex is obviously been growing exponentially, but there's still a lot of business in equities and futures. So how are they split, and where's the big growth?
Well, I think Forex is the big growth area of opportunity. For us, it's a great opportunity because, as I said, the volume of liquidity nodes that are required to be connected, and in today's world, that's data centers. The more liquidity locations there are, the more complex the requirements, and it's that complexity that we solve for. We make it easy, whether you're a buy-side firm, a sell-side firm, or a service provider selling into those markets. Certainly the equities and futures markets see growth. We see change is probably more appropriate. With the regulatory environment, we are seeing folks leaving larger firms and starting their own shops, and they don't have the big infrastructure that they had behind them in the past, and so they're looking for new and more cost-effective infrastructure. So we as a company see growth in those areas. I'm not sure that's net growth in the market or the volumes of trading, because you have someone trading just for a different entity, but it is a different cost profile in terms of the infrastructure they can support and how they support that. So I think when you talk about net growth, I think FX is probably where we're seeing the largest volume of new growth around electronic trading, new participants coming into the market, and that's an exciting thing. And it's a worldwide phenomena. It's less subject to regulation, which is, again, I think another reason that drives a lot of the growth. And so there's just a lot of opportunities there, and we look forward to those opportunities over the next couple of years.
Okay, and finally, where do you see your company going over the next couple of years in terms of growth and direction?
Well, we're going to continue to expand our footprint. As I said, we connect 70 liquidity venues around the world today. Within the next 2 years, that'll be 400, and within 5 years, that'll be 1,000. So we're going to continue to expand across the financial markets and then go deeper within those financial markets. And that's what we're looking forward to, is enabling this infrastructure and democratizing the infrastructure so that it's easy, whether you're a large firm or a small firm, to take advantage of a very high-performance infrastructure globally.
And Mark, if somebody would like to email you, could you give us your email address?
Absolutely. It's mark.casey, C-A-S-E-Y, at CFNServices.com.
Excellent, Mark. Thanks very much. Coming to you from Trade Tech 2012 in London's Excel Centre today.